What if instead we added a zero? But Jane knows that there's this weird little provision in the tax code under section 1031, which is where we get 1031. And she can do a 1031 exchange, follow all the steps that the IRS sets out. And by doing that, she can defer paying the capital gains tax, instead reinvest all of her earnings into a new property or properties. So that's what Jane does. She takes all of the net sales proceeds from her $150,000 sale, and she, using the code provision, rolls it into new properties. And by following those code provisions, she's able to defer her capital gains taxes until sometime later. So Jane has been able to have that $7,500 that John paid to Uncle Sam. She's been able to keep it as equity in her new property. The other thing is, John has not only lost the $7,500 in equity, he's also lost the opportunity to compound that by earning the interest or the cash flow or the appreciation that $7,500 would have given. But Jane keeps all of those benefits to herself. So what we see with investors is the reason that we're doing a 1031 exchange is we're able to keep that additional equity to ourselves, pay Uncle Sam nothing, and then over time, we're increasing our rate of return, we're increasing our cash flow, we're reducing our debt service. So these are all goals that the typical real estate investor has. So we're kind of getting the best of all worlds. But what if instead we added a zero? So now instead of a $50,000 gain, John has a $500,000 gain. And instead of writing the check to Uncle Sam for $7,500, now we're writing the check for $75,000. Does that feel like it hits you a little bit harder? Makes you kind of draw in your breath a little? Well, let's add another zero. So now we've got a $5 million gain, and the check you would write to Uncle Sam is $750,000. Well, now that's the check nobody wants to write, right? And so what we see is the more that we do this and the bigger numbers we use and the more real life it becomes, then the savings, like, we really understand those.